Well, I'd like to thank everyone for attending the special call investment committee meeting. And I want to actually also give kudos to our staff for operating under pressure, noticing that we were not going to get in compliance and doing all that work and getting us here. But most of all, thank you all for being here and happy holidays to you. This will be very brief, I think. And I just want to make one, no, not apology, but reality. The reason, as a lot of you know, so many deals need to get done by December 31st, whether you're in the real estate business. And if you know a real estate attorney, they don't get to see their family during the holidays as they're closing things and tax reasons and et cetera, et cetera. This deal that Stephen is going to talk about is one that needed to be funded or by us to get in December 31st. It looks very attractive. It is I won't say non-correlated because anything has some economic correlation, but it is something we're not into. And if you've read the material, 10% history of returns looks attractive. So with that, an opening legal statement, please.
Yes, sir. For the record, I want to note that this is a special called meeting of the Investment Committee of the Kentucky Retirement Systems. This meeting is being broadcast via video teleconference pursuant to Kentucky Revised Statute Section 61.826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road, Frankfort, Kentucky. It is also being broadcast to the public via Facebook. I ask if you are speaking and not appearing by video, please identify yourself before talking. In the event this meeting becomes disconnected from Facebook, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to another date.
Thank you very much. Could we have a roll call, please, Sherry?
Yes, sir. Mr. Lane,
Here.
Mr. Atkins,
Here.
Miss Bova,
Here.
and Miss Thompson.
Here.
Thank you.
Thank you. And any public comment?
No, sir, no public comment today.
All right, thank you. And I will vote Mr. Atkins as the winner of the holiday sweater contest today.
You ought to see my pants if you're impressed by the sweater. It's
Oh my gosh. We don't have time.
yeah, not good.
Okay. Moving on to the real agenda here. Again, I want to compliment the staff for the work on this and on this deal. Anthony, I believe, was up in Chicago recently doing an on-site, and it is vetted very, very well. And I'll turn it over to Anthony. Are you going to lead the discussion?
I'll start a brief
I'll let
intro
Steve
and
talk, and then I think we'll chime in. So thank you. Great.
yeah, I'll start a brief overview and then turn it over to the expert here, Anthony. That's good right there, Sherry. So we really appreciate everyone's time and flexibility today, especially on such short notice, to allow us to an opportunity to present this investment recommendation that we're excited about. I also want to really thank Sherry and staff. They did a great job coordinating. I know it's difficult to get on everyone's schedule, and we've asked a lot of her and her team, so we really appreciate all their work. As we've discussed at past meetings, staff has been very constructive generally on transportation assets as real return investment opportunities. We've been actively exploring several alternatives, which would be complementary, especially to the barge leasing investment that we made last year. And as Pruitt mentioned, Anthony really deserves all of the credit here for sourcing what I view as a really great opportunity. We've been engaged with IT and monitoring this specific fund for more than 5 years. Unfortunately, following their acquisition of SMBC Rail Services, the firm closed fundraising, essentially shutting the rail fund off to new investors. And through Anthony's efforts and persistence with IT, he was able to position KPPA as a frontline investor option should an opportunity arise in the fund, which is the catalyst for the opportunity we're presenting today. And as Pruitt mentioned, it did come pretty quickly, and there is a timing element to it. So we appreciate, obviously, your flexibility in scheduling these meetings. As you're aware, for several years, the portfolio has maintained a structural underweight to real return asset, as there was a lack of compelling investment opportunities, especially on a risk return basis compared to other asset classes. With the recent changes to the IPS asset allocations, as well as shift in market dynamics and the opportunity sets in the real return asset class, that's become a focus of staff. We brought several investment recommendations to the investment committee and the board over the last several quarters. So currently, including the liquid proxy investments, all of the portfolios are right at or very near their target real return allocations. As we continue to source compelling investment opportunities such as this ITE Rail Fund and capital committed to other investments as called by those managers, we will unwind the existing proxy positions to fund the new investments. So everything that gets funded will come out of those proxy investments as we wind them down. When fully funded, this investment would represent approximately 100 to 110 basis points of fund assets, which is appropriate. When we consider sizing for funds, one of the key elements we look at is the volatility, and then the volatility relative to the potential yield or return on the investment. And for this asset class, we want to, our goal is really to build a durable, resilient, diversified portfolio. And so about 100 to 150 basis points of exposure for this type of asset, I think is where we've landed, is a reasonable position size. As we've talked about in the past, the real return landscape is very broad and encompasses a multitude of public and private asset classes. As a staff, we focus on sourcing and reviewing differentiated real return investment opportunities with a number of key characteristics: compelling economics, favorable standalone risk-adjusted returns, as Pruitt mentioned, low return correlations to both the real return investments already in the portfolio as well as to the broader overall portfolio, both on public and private side. Provides inflation sensitivity and meaningful diversification. And also we err towards providing yield and current income and prefer that from contractual cash flow streams. We believe this investment meets all of those criteria, and we're excited to present it today. And with that, I'll turn it over to Anthony.
Yes, thank you. Sherry, can you go to the next slide, please? Well, this kind of talks about some of the real return strategies that we have been working on. Obviously, like Steve said, the transportation leasing has been an attractive area. This is the rail car investment we are recommending. Our inland marine investment has done well as we have expected, and they continue to see good opportunities to add vessels. So they are thinking that they will have an opportunity to call more the rest of our first commitment, and then perhaps some more capital in the first half of next year. So we're in position to be part of that. Next is the sports. We're also still working on that. Again, we made that commitment a couple of years ago. As you guys might have seen in the news, the NFL recently became the last big US league to allow private equity investments. And so you also may have seen that the first ones just got approved. So Arctos, our Fund 2 investment, is now an investor in the Buffalo Bills, and in different fund Ares invested in the Miami Dolphins. So those are the first two deals that were approved for institutional capital. Steve and I actually talked to them yesterday. They have several active live deals continuing, especially as now that you have proof of concept out there. They have some very active conversations with some owners who definitely would desire working with Arctos and utilizing some of the things that they've been able to do with other teams in terms of adding value around their franchises and properties and things like that. So that's definitely of interest and something that we'll probably be looking to present in the first quarter of next year. Another area where you guys might remember, we worked on the continuation vehicle for one of our Kane Anderson Energy Fund. That was done about 8 years ago, and that is going to be part of an existing production-focused fund that's going to close in the first quarter of next year. And so we are also looking at that as well and other strategies related to that. There's a lot of instead of the higher risk strategies that were more private equity in the mid 2010s, these are more strategies that have acreage and are currently producing income, oil, and they may have some drilling upside or just mostly be focused on production. But since capital's kind of left those areas, we have an opportunity to be a provider there and be important and potentially provide some good returns for our members. And then you can see the rest of them. Those are some of the areas we've initially looked at and had some calls and looked at reports at, and but we're these other things have kind of bubbled to the top first. So, Sherry, could you go to the next page, please? I mean, Steve, do you want to talk to this now, or what would you prefer to do?
Sure. High
Okay, sure.
level, this is just using, so this is KRS pension portfolio is representative of all of the different portfolios, but it's kind of where we are currently from a broad asset allocation relative to the IPS targets, as well then drilling down into the current real return allocation. As we discussed, our intent here is to kind of build a durable, well-diversified portfolio with those characteristics that we talked about. So this is where we are currently, and if Sherry, you'll go one page forward. So if all of the capital that we have currently committed, approved and committed, as well as you'll see that the ITE fund is on here. So when all of that capital gets committed and called, this is what the real return asset allocation would look like. And in fact, it would be right here. This is at target. So this is at the target IPS allocation for real return. So we still have some work to do in winding down some of the proxy assets. So we'll need to source some additional investment opportunities, but we made a lot of progress, especially over the past 12 months, in deploying and obviously sourcing investment opportunities and those managers deploying capital. So I think this is it's a well-constructed portfolio where we like the characteristics. I think from a risk perspective, from a volatility perspective, it ticks all our boxes for that real return asset class. We'll pause there for questions. I know if it's a lot going on that chart. I apologize for the small font. If not, Anthony, you can continue.
Sure, we'll go to the next page. So the IT Rail Fund, it is they started about 10 years ago as a firm. Right now they're trying to be more broadly across transportation, but historically their primary focus has been rail car leasing. It started with 3 people, 2 of which have been investors, and a third operating partner that they found who has the industry expertise and was able to help them overcome some of the barriers to entry to the space. Kind of like we've talked about with farmland and inland marine leasing. They're relatively smaller industries where relationships really matter. They've kind of have different smaller players that have been entrenched in the business for a long time, and just kind of getting in is not super easy. But with the combination of the team that they were able to form, they were able to acquire rail cars and then also build some scale and become more credible over time. There's been 3 main acquisitions that have really helped them build the fleet as well, besides just taking cars from some of the manufacturers. And the first one was they took American Rail Industries private in 2018. It was public at the time, but majority owned by Carl Icahn. And the person who had run that business as their CEO for several years is the operating partner that IT worked with. And so he obviously knew the assets very well, and was able to buy them. They were kind of a logical buyer of that, and this more than doubled their fleet and kind of set them on their way. It brought them, besides just the assets, they also had a repair and maintenance facility network. It also had a manufacturing capability, which was not really their focus. So during the diligence process, they kind of made it a clean transaction where they had it set to sell the manufacturing part to another manufacturer. So they were able to, at the same time, kind of make a clean deal happen and have a really nice asset for the fund. And after that, from there, they've made 2 other acquisitions. Most recently, the Sumitomo acquisition that Steve mentioned, that also again doubled their fleet to almost 120,000 rail cars. And so that makes them the 3rd largest lessor in the country. So they have scale now, and like the other leasing businesses, these are essential goods that they're transporting. It's kind of there's not many players, and the supply dynamics are also very favorable right now. In the past, that has not been the case, where sometimes maybe more cars have been built. But given how things have been the past few years with inflation and COVID and labor dynamics, it's just not, those things aren't being built on spec. Basically, the amounts that are being produced are basically to replace the retiring fleets. So that makes the cars that they have existing assets quite valuable. The utilization is very high. Kind of like the barge leasing, you can track it with the public companies. We track for maritime, we track Kirby, and for this, we look at GATX, we look at Trinity, and some of the stats they have also reflect the same things that IT is telling us, which is that they have long-term contracts, but as they renew, the prices are significantly higher. So just the past few quarters, if you go to, let's see, this page here. So the very bottom of this page, you can see GATX has a lease price index indicator they have. And so the difference between the average renewal lease rate and the expiring lease rate for the past few quarters has been over 25%. So like there's definitely markups. These are assets that are important and useful. They're relatively inexpensive compared to the cargoes they carry. So if you're an Exxon or you're Archer Daniels Midland, people carry, this is a small portion of the cost for carrying your cargo, which is much more valuable. So these are things that you want to have around and not be short of if you need to transport things. So that's, I think, is part of why the returns have been quite consistent over time. So the income return just on the leases is quite attractive. They try to get payback within the first lease term, which is 5 to 7 years typically. And then after that, these are 50-year assets. So they can just continue to produce income and be valuable in the fleet. So another thing we've liked about IT is that they've made sure to diversify the fund over several dimensions. So things that they carry, different types of cars, the age of the fleet. So there's almost no concentration in any of this. So it's a very diversified area.
Or from a leasing perspective.
Yeah. It's a contrast to barges, like, even though maritime was very attractive and still is, because there just aren't a lot of people doing that, or not a lot of equipment out there. In this case, there is little concentration because there's many people who use rail and many players, or many lessees who need rail, and so they have over 500 of them. So, or over 500 commodities, over 1,000 lessees. So it is a very diverse portfolio in that way. So. Yes, like Stuart was mentioning, there is correlation, of course, to economic activity to some extent, but I think we've had proving ground with COVID and other slowdowns that people still need these assets, and it's kind of like when you rent an apartment or something like that. Like if you go on vacation, you still have to pay the rent. Same thing for this. If the cars are idle or if they're moving stuff, you're still paying. So those are all things that are pretty attractive and resilient, and I think a good fit for our real return area. And going to have less correlation again with public fixed income, public equities. These are just things that are just going to, maybe not the most exciting things in the world, but they're going to keep going. They're very necessary, and they can produce an attractive income return for us. But I'm happy to take any questions if you guys have it.
I'll add a couple of comments, Anthony, if you don't mind, before questions.
Sure, of course.
So this is
sorry.
what's real, as we mentioned that. So they offer a more diversified fund that's more than rail, and our preference here is we like the pure play in the rail. That was our preference. That's where we would like to invest. And one of the differentiators for IT is, so they own a maintenance and service company as part of the platform, which provides them a lot of unique data and insight. And that's one of the things. We actually were on a call with them earlier this week, and one of the it's a great comment that you can't be a tourist in this asset class, and that's that both the depth of the resources on the team as well as the platform itself, and what they've taken the approach to kind of rail has been around forever, right? Or certainly for a very long time, and their approach to modernizing how the management of the lease and the cars work. And as Anthony mentioned, even in one of the comments is even if there's a potentially slowdown, the lessees like to have access. They will maintain their leases on the cars because they don't want to get caught short. So even if they're sitting idle, they'll necessarily maintain those. And so it's a very differentiated management strategy and approach in a very fragmented market, which I think gives them a pretty good advantage. That's one of the reasons that we really like the platform.
I think it sounds very, very interesting, as I said in my at the start. And at this point, I think you've very thorough analysis, and let's see if there are any questions from the committee members. Well, I'm hearing none, so would someone like to make a motion to approve this this fund for our purchase, for our investment, excuse me?
I'll make a motion that we approve the fund purchase.
Thank you very much. Second? I think we have a second there. Yeah, I think we'll do a roll call just to be consistent. All of those in favor of the not a roll call, we'll do a vote. All those in favor of the motion, please say aye.
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 All those not in favor or against, say so, or forever hold your peace. So the motion is approved, and we'll see see this in the portfolio next year, and I'm sure the results will be excellent. So the next item on the agenda is adjournment,
Mhm.
and I will.
But doesn't this go to the full board now?
It does
Gotcha. Okay.
in 5 minutes, but
Yeah.
it goes. The full board's a ratification, so
Yeah.
the presentation will be shorter since
Yeah.
most of the board's already heard it.
Sure.
And we'll ask for ratification and then move forward.
Perfect.
But good point. So with that, we'll adjourn this meeting and see you in 5 minutes.
Well, thank you
Thank you
very
very
much.